Our first common claims example, number one, the situation is that an accountant completed state and federal tax returns for a new client. Upon reviewing documentation, the accountant discovered that the client had multiple streams of income, including a taxable amount of a pension from the state. The accountant made final calculations for the client and completed the 1099-R filing. The mistake. An error was made when the taxable amount of the state pension was entered with one less digit. This reduced the client's income by $44,000. The accountant failed to have checks and balances in place to correct mistakes made in final calculations of 1099-R filings. Using a robust tax software system and having good internal workflow protocols help to ensure accuracy and enforce the segregation of duties. The key is to prevent errors prior to the filing. Aside from a potential claim, there's also client trust and your reputation to consider in these situations. So what was the result of this claim? Such a drastic decrease in income reduced the taxes owed and increased the client's refund. After an IRS audit, the client owed $8,782. Upon realizing the accountant's mistake, the client threatened to file suit unless the payment of back taxes and penalties was paid. How could this have been prevented? Well, this accounting firm could have avoided this claim if they had checks and balances in place and a pre-established checklist to review the filing. This claim was ultimately settled because the accountant admitted liability and failed to attempt to refile or amend filing to mitigate damages. In the end, litigation was avoided after it became apparent that the accountant would have been found liable for the error. Smaller firms, especially solo practitioners, are more susceptible to these kinds of claims, creating good habits like always reviewing your checklist and validating your work, especially if a large refund wasn't expected or the numbers just look off, can help to avoid a claim. Errors occur more frequently when we are overworked, we're trying to rush through a process, or we lack the support we need, especially during tax season. So what was the real true end result? Well, this firm paid their deductible, could have been $5,000, $10,000 out of pocket, and then the insurance paid the excess. Then this claim hits their loss ratios. And so on their loss runs now, they're going to be assessed for the next 3 to 5 years. And at each renewal, when comparing carriers, this claim is going to show up. They're no longer going to be able to answer yes, that they've never had a claim or haven't had a claim in the past 5 years. And this could mean the loss of any claims-free credits or potential risk management credits and increased scrutiny through underwriting at renewal or when shopping for coverage.